The biggest thing that you don't know as you grow your net worth ultimately is around understanding your liquid net worth, your cash flow, and the investments that you make as you propel yourself to increase your wealth, preserve it, as well as steward it. This is not something that you're traditionally going to hear from financial advisors, whether you have one or you don't. Even if you have one and you don't listen to them, this is going to be in detail of what specifically ultra high net worth individuals and family offices do in terms of how they go about investing, looking at their liquid net worth and not just their available cash on hand or ultimately their overall net worth. So let's dive in. First and foremost, we're going to define what liquid net worth is. Essentially, it's the value of assets you can quickly turn into cash minus your debts. Now, these are debts in terms of like consumer debts, not necessarily debts in the sense of real estate. If we were going from the real estate sort of Dave Ramsey perspective, we would never have any flipping money, right? Now, we want to ensure that both our spending is on par and our income is to the max abundance that it can be, right? Not the episode that will go through that, but ultimately keep in mind this is a huge equation with your liquid net worth. Now, in terms of what considered a liquid asset, so think of cash in the bank, think of things that are stocks that you could, liquidate, but they are not tied into a 401k or Roth IRA, specifically because those are tied to, those investment accounts, which have penalties if you withdraw early, et cetera, et cetera. The other thing that we could consider is the cash value of a whole life insurance policy. Whole life insurance essentially is over, essentially a 100-year timeline. They're doing a presentation value of what it is today, of what you have for the principal value that you have created and the cash that you've accumulated. So meaning to say that you have a value of what you need to increase to get it to a certain limit for what the policy is worth, right? That's going to then give you a cash value when it's a surplus of what the policy expense is, because you're paying over what the amount is to keep the policy in check. Now, learn more about whole life insurance policies, but they're a great way, I believe, to have a additional cash value sort of aspect to them. Better than term, granted it depends. So again, let's talk about that in another video. Okay. Now let's talk about our liabilities, and then we're going to go into what sort of rules you ultimately need to follow so that you can ensure you are investing the best way and the most accurate way, regardless of what happens in the economy, in your personal finances, etc. So in terms of liabilities, we're going to extract everything that is, say, car loan or consumer debt or anything you own that is going to be some sort of debt. Again, we're not going to include things like real estate, but even things like personal loans, student loans, we want to be aware of and potentially include. Reason being is that if we took, say, $100,000 that we have and we just took 50,000 of that and invested into a private placement, we would then only have 50,000 left. And if we say lost our job and our living expenses are 30,000, well, then ultimately that means that we really only have a maybe 3 to 6 month runway that we have for that rainy day fund. And then we have nothing left, right? If this investment goes kaput and requires more investment, and then we have the doomsday situation where we lose the job and can't get a job, we have all these issues that transpire. Now, this is really going to be most applicable to those who have a 500,000, I would say to about a $2 million net worth, because you then have excess cash to be able to invest. This also is going to be for someone who has a high income job where maybe they're making 400,000, but really their expenses are like 100, 150, maybe 200 with a family, if you will. That then is going to mean your take-home pay is then going to give you the ability to invest. So how do we do this calculation in terms of what the investment is? We're going to think of what the amount we have, again, as liquidity subtracted from our debts that are consumer debts, and then what is remaining, we're going to have the liquid net worth. Again, liquid net worth is beyond emergencies, so the traditional 3 to 6 months that you have for living expenses. It's also beyond the annual expenses that you need to save for. This is specifically calling out, for example, think of if you own a home, take the fridge, all the appliances, if you will, as well as maintenance for the car, and annualize them over the past couple years, as well as the projected of what they're going to be. It's not just living expenses, but it's also ongoing operational expenses that you also need to include in a rainy day fund. Beyond that, you want to ensure that you also have different levers. So levers, again, being like the cash value of a whole life insurance policy. Again, some stocks that you could liquidate. Granted, you are going to be hit depending if it's a short-term or long-term capital gain with that stock. So I wouldn't necessarily count those as that, although some people see them as liquid because they're really semi-liquid by definition. And then, of course, we're going to want to equate what is remaining. After we do this equation with what's remaining, we then need to recognize if we have a safety net or not. The safety net is to say we should do the 25% rule. So if we had $200,000 in liquid net worth, we then subtract all these different expenses. We ultimately had $100,000 that we could invest. When we think of investment for these more higher-tailed alternatives and private placements, that's then going to be things like investing in multifamily or other commercial real estate assets. It's also potentially investing in oil and gas or maybe a debt fund. There's also the potential for venture capital, but venture capital is not recommended anything that is below a $5 million net worth. Traditionally being because you either don't have the skills, knowledge, resources, or experience to ultimately take the risk for it. And oftentimes people go with the idea on it, but aren't able to actually underwrite it. If you are able to underwrite it, ultimately buyer beware, and then you have the potential to maybe invest in a company. But keep in mind, traditionally, from a venture-backed sort of investment, you're not going to get that capital back from 5 to 7 years. As well as I've seen in the family office space, it's actually turning into more of a decade or longer. So again, would not recommend it in any sort of play. But again, there could be reasons why you do that. Now, let's finalize what the 25% rule is, because if we had $100,000 free and clear of your liquid net worth, we would maximum do 25%. Most private placements require a minimum of $50,000 to invest, meaning that we would need to have at least $200,000 of liquid net worth before we go about doing an investment. There's a difference between taking money to use it to invest and having money to invest. The difference is that you have the firm foundation, you have the bricks and sticks that are ready to build the house, and then you have excess. That excess is then meant for investment. You shouldn't be using the funds that you have for the foundation or building the bricks and sticks, essentially your life and living and the annual expenses that would certainly come to be, because we all know appliances are going to go out at some point. Your car's going to need new tires, things like that. We can't just negate that because ultimately we're going to put ourselves at a cash flow deficit, which would then cause issues with our finances, especially if we're not prepared, which traditionally everything happens when you're not prepared. So keep in mind not having a cash crunch, recognizing that you might have missed opportunities, but ultimately you're not over leveraging and having a total loss risk. Reason being is that sometimes these private placements have what are called capital calls. And so I've seen a number of people in the middle sort of net worth space that are ultimately putting, say, $50,000, $100,000 into a private placement, hoping or thinking that they'll get some sort of equity multiple after 3 or so years, or potentially it's cash flow. But the issue ultimately is that it means there is a challenge on what you actually have left to invest. And as these issues come to be, you're going to be challenged potentially, although not always the case, that you're going to have to ask for your principal back. And again, if you experience a capital call, that means you're going to have to put more money in just to save your money. And you would also get a reduced amount. So imagine putting $100,000 in, only able to needing to put $20,000 more in at a capital call, and then you potentially get $50,000 of that back, right? And there's a bunch of different nuances here. I don't want to scare you in terms of private placements. Read the private placement memorandum, as well as understand the risks that are associated with investment, but recognize that ultimately there are a number of things to consider before you just give $50,000 to someone that you met at a meetup event who seems to have a good deal. You want to ensure that you're investing with your liquid net worth in private placements, but not with your savings or your living expense annuals that you should be considering as well. If there's any questions about the equation or details about it, as well as deals that you might have, consider commenting below and let's have a conversation about it.